Hi guys, and welcome to the Recipe for Business Success. In this masterclass, we're going to talk about a couple of things, but one of the things I'm going to be concentrating on is profit acceleration. So, if that's you, you're definitely in the right place. Now, before I get started, I just want to do some housekeeping rules or things that I want you to do to get the best value from this presentation today. One of the things is grab a piece of paper and a pen and take notes. Take lots of notes. Now, I'm recording this as well, so if you want the recording, please reach out and I'll be able to send that to you. But the other thing I want you to do is just to relax and learn as much as possible. My main vision is to teach as many business owners how to build a profitable and successful business. And you can put your credit card away because there's nothing to buy at the end of this presentation like other workshops or masterclasses that you've been to. So let's get started. Now, if you don't know me, my name is Paul Duncan. I'm the CEO of a company called Competitive Edge Coaching. I'm a business coaching marketing strategist, but it has been my passion for over 20 years to help small to medium businesses generate more revenue, more profits, and grow their business. Now, I'm a best-selling author of a book called Dominate Your Market, What the Marketing Experts Don't Tell You. And I've also written various other books and ebooks around the subjects of market strategies and the 45-minute business breakthrough, which I put in step-by-step on how I find any business $100,000 in 45 minutes. So if you're looking for that book, reach out, be able to send you the download for that. And I've also been working on a series of books that are titled The Recipe for Success, which go into strategic marketing, digital marketing, financial success. And I've just finished the recent one, which is the 12 business acceleration strategies to increase your profits. Now, I've owned and operated over 18 different businesses. And I say different businesses because I do come from a food background, but I've owned businesses in the floral and flower industry, construction industry, key cutting, and right down to fencing contracting. But I have also run a highly successful food franchise here in Australia, so know a little bit about multi-site franchising, multi-site operations as well. So it gives you a little bit of background about what I'm about. But before I get into the presentation, I just want to share you a quick story, and it's called the Paper Run to Entrepreneurial Story. And it's about me, what's pretty much shaped me to come and speak to you today. Now, I want you to think about when you were at school. Did you have a part-time or casual job after school? You might have worked at the fast food places like Hungry Jack's or McDonald's. You might have worked at the local supermarket as a checkout chick or filling those shelves with stock. What I did was I had a paper run. Now, if you don't, I can't remember what a paper run is. After school, we used to hop on our bikes, we'd collect some papers and we'd deliver them to the local community. Now, I always zig when other people zag. So when I had my paper run, I actually had 3 running at one time. So I had my friends help me deliver the papers. And at the end of the week, when I got paid, I'd give my friends a little bit of pocket money for helping me out. But in essence, what I didn't know at that time was that that was my first business. I had some income, I had some revenue, I had some employees, and I had some expenses. So in essence, that's what a business is about. So, why am I telling you this? Well, it's really shaped me to be a successful business owner, but more importantly than that, it's made me an entrepreneur in later years in my life. So we tend to forget of where we've come from and how those experiences in our early years can really benefit what we're going through right now. So I just wanted to sort of bring that to your attention right now. Now, when I did leave school, I became a qualified chef. So I did my qualifications as a chef and then moved on to the Hilton International Group as an ambassador. So what I did was I traveled around the world lifting those standards. I was employed by Conrad Hilton in those days, but I just needed to lift those benchmarks and those standards on a global level. Now, in those years that I was away doing that, I was teaching a lot, but I also learned a lot around business as well. So after I did come back to Australia, I opened up my first business, and you probably relate to this. It was very stressful, little return on my investment for my time and money, and it was very, very long hours. So I thought to myself, well, there's got to be more to business than just this. So I started reading. Now, before that, I didn't read a lot of books, but in many years after that, I realized that readers are leaders. So one of the books that I did pick up was a book called The E-Myth. You might know it, by Michael Gerber. And it was among other books that I had read that really, really changed my life. But more importantly, what made me successful in business and how I looked at business from a different angle. Now, what I learned from the E-Myth was that you need to be three people in your business. The first is a technician, which is your skill level, and that's where 95% of businesses are really stem from. As we bring our skills to the business. So what I mean by that is, as a chef, my first business was a cafe and restaurant. If you're a hairdresser, you open up a hairdressing salon, a bakery, and that kind of stuff. So it's around the technician, and we really open a business that caters for our skills. Now, what I learned in the book is that more importantly than being a technician, where I think about 95% of businesses come from is from the skill level, but more importantly than that, you need to be a manager. You need to understand the day-to-day runnings of the business. So what I mean by managing the marketing, so bringing in leads, bringing in customers and clients. You might employ people, so you're bringing on a team, so you need to know how to recruit them, how to pay them, how all the tax obligations in getting an employee on board, which then brings back to that tax implications of invoicing, accounts receivable, all those things that are associated with managing a business. Now, more importantly than being a manager, you need to be an entrepreneur, which really, really changed the way that I looked at running my business. I became a visionary. Now, if you haven't, if this is very foreign to you, I suggest that you start reading books from Stephen Covey, because he talks about having the end in mind. So looking at the end, looking at the future, and actually bringing it back to now and putting those strategies and those step-by-step processes to get those goals, visions, and missions that you have for your business out in the open and really, really happening. So once I understood all these sort of concepts, I opened up my business, Competitive Edge Coaching. And it was really modeled off what I call the recipe for success, okay? Having the correct ingredients and the right method. And this stemmed back to when I was in the kitchen. If I wanted to make a good dish, what I'd look for is the right recipe, right? Which means that the correct ingredients and the right method. So in the business world, I'd put that in the ingredients for, like, digital marketing, for instance, would be your website, your Facebook page, your LinkedIn, all those social media platforms. That's the ingredients. The method is what you say and how you say it. Now, one without the other will not work. If you have the right ingredients, but you don't know the method, it won't work. Vice versa. If you know the method, but you don't have the right ingredients or the right platform, you're going to fail. So this is what my whole business is based on, and this is how I help my clients really move forward and really succeed in their business. So anyhow, that's enough about me. It's let's get started. So today, what my goals for this presentation itself, as I said, is around profits, because I believe a lot of business owners are really focused on sales and revenue, and they lose the focus on profits, right, a lot. So I want to really, really focus on that today. So what I want to try to do is to help you uncover tons of hidden profits that are just hidden in your business. I also want to introduce you to the awesome power of profit acceleration. Now, if you haven't heard of profit acceleration, this is just going to blow your mind. I want to shift your focus, as I said before, from revenue to profits, because I truly believe that profits is where a business is made, not in sales and revenue. I'm also going to show you how you can generate the exact same amount of profit as $1 million business with just 25% of that revenue. Because when I ask business owners what their goals and visions for their business are, they come back and say, look, I'd love to be getting to the $1 million mark in my business's turnover, because when I reach that, I'm then going to start making some money, right? that could be the furthest from the truth that I've seen, right? Because even with a small amount of turnover, you can still turn over the same amount of profit from that $1 million business makes. I'm also going to show you how to double your current profit in less than 90 days. So if you're not at that $1 million mark, at your $500,000 or even $100,000 mark, I'm going to show you how you can double your current profits with that revenue. So that's pretty much what I'm looking at doing today. Now, I'm just going to introduce you to what I call the profit zone. It's a little bit of a graph, but it's really breaks down what we're going to talk about today. So the profit zone, this graph actually just has two lines. It's the total revenue line and the total cost line, okay, which is two main areas of your business that you should be concentrating on, right? Now, the difference between your total revenue and your total cost is your net profit. Okay. On the other end, the difference between your total revenue and total cost is your losses. So I just wanted to sort of introduce that to you so you get an understanding of what we're going to talk about today. Now, the business net profit zone, right? What we want to try to do is it really represents your bottom line income and your salary. But what we want to try to do is to make that zone as big as possible and as fast as possible. Now, there's 5 options to increase the net profit zone, and that's what we're going to talk about today. But the easiest is to raise your prices. Now, before I get into that, I just want to discuss 2 major factors that really affect increasing your prices. So, if you haven't increased prices for a while, which I see in a lot of business owners out there, right, this is going to help you understand why you haven't increased your prices. Now, the first factor is misunderstood pricing. Okay, we really don't understand pricing to the full extent. So I'm going to explain that in a little bit more detail. So I'm going to give you a little bit of an example. So let's say you sell widgets and you've got $100 material plus $75 labor. It means that you've got $175 cost of goods. Now you want to make 35% profit on each one sold, right? What we normally do is or what I see business owners do as a calculation is they get that $175 cost of goods, they times it by 1.3, which is their 35% profit, and they get, in this case, $236.25. Now, is that really correct? Is that sales or that revenue you need to generate, right, with your cost of goods to produce a 35% gross profit? Well, I've got a little bit of a calculator, a little bit of matrix that I work to, right? So I'm going to take you through that today. Now, we put our revenue in there. So we put in our $236.35. Now, we know our cost of goods is $175. The widgets mean $100 material, $75 labor gives us cost of goods at $175. So if we take $175 from our revenue, we then get our gross profit, which is $61.35 in this particular case. Now, what our normal calculations is to find our gross profit percentage is our gross profit divided by our revenue. So if we do that in this particular case, we get 26%. So we're only targeting, really generating or targeting about 75% of the profit that we're really looking for. So where did we go wrong? So let's go back to our example again. Let's say you sell the widgets for $100, $175 labor. We have $175 cost of goods. Now, we used that calculation at $175 times 1.35. We then get our revenue, but we know that's wrong. So we need to really inverse those calculations to calculate it properly. So we now need to go 175 divided by 0.65, which is the right calculation, which gives us $269.23. So let's try that out and see if that's revenue we need to generate 35%. So we put in our $269.23 as our revenue. We know our cost of goods is $175. If we take that from our revenue, we now get a new gross profit of $94.23. We look at our calculation, 94.3 $2.23 divided by our revenue, $269.23, we now get our gross profit 35%, which is where we're really looking at. So, you know, this is where I see a lot of business owners looking at, I want to increase my my profit margin or my gross profit percentage, but I don't know what revenue I need to be generating to get that 35% or that 40% gross profit with the cost of goods I've got. So we really need to inverse that. So hopefully you've learned something in the first sort of factor that I see out there. The second factor I see is discounting, okay, which is a really, really big one for me because we see a lot of business owners out there discounting to try to generate sales and revenue. Now, the small business owners that discount their prices, they really end up destroying their profit margins. Now, depending on your margins, if you discount your price by a mere 10%, you now have to sell 50% more just to break even. Now, I'm going to go into the break even a little bit more detail because it's another thing that I analyze with a lot of business owners out there. They don't know their break even point. So I'm going to take that through you a little bit later in this presentation. But in this case, if you sell a widget for $100 and you have to have or you want a 35% profit margin, right, you end up making $30 for every widget you sell, okay, which means that your cost of goods for that widget is $70. $100, $30 profit margin, your cost of goods is $70. Now, if you discount that widget by 10% and sell it for $90 instead of $100, your cost of goods is still $70. That's not going to decrease. Now you're only making $20 in profit instead of $30. So you now have to sell 50% more widgets to get back to that original profit margin. 100 widgets at $30 will give you $3,000, but now you have to sell 150 widgets at $20 because you've reduced it by 10%, right, to get $3,000. So you really have to sell 50% more widgets to get to your profit margins. Now think about that for a minute. For a measly 10% discount, you now have to sell 50% more just to break even. Now, when was the last time you saw anyone offer a 10% discount? It's more like 25%, 40%, even 15, 60% I've seen out there for a lot of sales. So think about those businesses that have got a 50% sale on or discounting it, how it is eroding their profit margins. So if that's you, definitely you need to look at how you're looking at your pricing. However, this works in reverse as well, which means that if you increase your price rather than decreasing your price, right, by 10%, and you sell your widget from $100 to $110, your cost of goods is still $70. But now you're making 40% profit instead of 30%, which means that that's a 33% increase in profit on a 10% price increase. So discounting assumes price is more important than value, but it isn't. Okay, the secret is you need to create more value through innovation in your business. Okay, so you really innovate your business so you offer more value than your competition, even if that means increasing your prices. So what I'm trying to say in this slide is that if you're looking at increasing your prices, right, look at innovating and adding more value so you can start increasing your prices and probably be a lot more than your competitors. But if you perceive value out there a lot more to the customers, price will not be a thought pattern for them. So I'm going to give you an example, and coming from the food and restaurant background, I'm going to give you a case study around a restaurant. Now, imagine a restaurant offers 25% discount on your favorite meal, which is $60 for 2 people. Okay. Now, I see this in a lot of restaurants and cafes out there. They look at discounting rather than anything else, or value in this case. So the restaurant offering the 25% discount on your favorite meal for $60, where a restaurant down the road has the same meal or same favorite meal at the exact same price, but they include a bottle of wine and a dessert for each of you for free. Now, which restaurant would you do business with? The one that's giving you a 25% discount, or the one that's giving you a free bottle of wine and a dessert at the end of your meal? Now, when we start breaking it down, the restaurant offering you the 25% off your $60 meal is a saving to you of $15, right? 25% off the $60 is $15. So that's what the value is in this restaurant. But the other restaurant, right, giving you the bottle of wine, right, which is listed on the menu for $25 and the desserts at $6 each, has a perceived value of $37 instead of the $15. Okay, so you're now starting to see where I'm getting to. The 25 bottle of wine only costs that restaurant $7 wholesale, and the desserts $1 wholesale each. So when we start breaking this down for restaurant A to restaurant B, restaurant A, the meal for two is $60. Their profit margin is 50%, so their regular profit is $30. But in this case, they're discounting it by 25%, which means that the cost of the restaurant with that discount is $15. But the perceived value is only $15, right? So their profit is $15 and the perceived value to the customer is $15. But when we look at restaurant B, the meal is still $60. Profit margin is still the same at 50%. So their regular profit is still $30. But the cost to the restaurant in the freebies for the bottle of wine and the desserts now come to $9, which means that their new profit is now $21. Okay, but the additional value of wine is $25 and the additional value of two desserts is $12, which means that the perceived value to the customer is now $37, which means that the profit for restaurant B is 40% higher than restaurant A, $37 versus $15. But as we mentioned before, people are going to gravitate to the bottle of wine and the free dessert over the discounting because a lot of restaurants discount out there. So you just, like every other competition out there. So can you see that the second restaurant that only spent $90 yet still created the perception that their customers were receiving much more value for the money, right? And in this case, $37 versus $15. Both the restaurant and the customer come out winners, right? Now, once the restaurant B promotes this offering, right, they then get into what I call the market dominating position. They now become unique. They have a distinct difference between other restaurants out there. So if you follow me or if you've seen some of the other presentations and workshops that I do, I heavily concentrate and focus on having a market dominating position, what makes you different. Hence why my company is called Competitive Edge Coaching, giving you a competitive edge against your competition. This is where we start, having a market dominating position, what makes you unique. You probably heard this a lot of time in marketing. You need to be unique. You need to have a differentiation, or you'll be competing on price with your competition. So this is a really, really easy way of actually doing it. So when we get to the 5 options to increase the net profit zone, as I said before, option 1 is increase your prices. Now, what I see is that most small business owners out there haven't raised their prices since never. Right? They can't even remember the last time they raised their prices, but their costs will have increased every year going forward. Now, why don't they increase their prices? Well, they're scared to death that any price increase, no matter how small it is, will lead to a mass exodus of all their customers. But is that really true? So let's say you're selling a widget for $100, and as we've said before, your cost of goods is $70, and you decide to increase that price by 10% to $110. Will that small increase really lead to a loss of customers? Now, in my history, a few will leave, but they're most likely your biggest price shoppers that show no loyalty or patronage to your business. They're probably your worst customers, the ones that you don't really like working with anyway. So, there might be some customer attrition, but to what extent? Okay. Now, I've tried this a lot of. A price increase is one of the main strategies that I use with my clients as soon as I get them on board. But if this particular business is making an additional $10, right, it is all profit, which is 33% 10% profit increase, right, with that extra in 10% increase. But for this business to make $1,000 in profit selling their widgets for $100 each, they would need to sell 33.3 widgets to get to that. But by increasing their prices by 10%, they only need to sell 25 widgets, 25 at $40, because they've got that 10% increase in their cost. So can you see that by just increasing it by 10%, right, your break even, right, which means that your break even point, right, you'd need to lose 25% of your customer base over a mere 10% price increase. And that's just not going to happen, right, at all. So if you're worried about increasing your prices, do the numbers, right? Have a look, right? Monitor it and really look at how much you can increase your prices by and when you can increase it. Now, I would be on the side of caution and test the increase on a small scale just to gauge the reaction. And I say that because a lot of businesses, as I said before, haven't increased their prices for a long period of time. So you want to do it gradually. You want to do it on the air of caution, right? Test and measure and see how that goes. You might want to just do it in a small amount of your customer base, right? And just test their reaction. But there is no simple or easier or faster way to generate additional revenue than to increase your prices. Now, I've got a little bit of a spreadsheet that I use with all my clients to measure the impact of increasing the prices compared to discounting or decreasing your prices. Now, if you want this, reach out to me at paul@cecoaching.com.au. Send me an email and I'll flick it through to you. Or you can go onto my Facebook page, right, which is the Edge Recipe for Business Success, and I've got it in the file section there. But how this works is that if your present margin is 30% and you increase your prices by 10%, your sales need to decline by the amount, right, 25%, right, before your gross profit is reduced. But on the opposite side to that, if you still have a 30% profit margin and you discount your price by 10%, your sales need to increase by 50% to keep that same gross profit margin. Okay, so can you see the difference between discounting compared to increasing your price? Right now, as I said before, your sales would have to, decline by so much, right, just to keep your gross profit the same. Now, have you ever seen anybody discounting their prices by 10%? As I said before, it's more like the 40 to 50% mark. So you can see this with the matrix, especially if you're in the retail market, right? You can now look at this spreadsheet and have a look how you're eroding your profit margins by the sales and the discounting that you're doing on a regular basis within your business. So if we look at the graph again, where is the break-even point, right, in this particular case? Now, the break-even point is here, but now that we're increasing our prices, okay, by 10% or 15% or even 5%, you can now see that our break-even point drops. So we have to sell less units to start break-even. Now that works in reverse as well. If you lower your cost, your break-even point will come down as well. So the two things that we really look at is increasing your prices and decreasing your costs in your business. The fastest way to actually increase your profit line with it. So option number 2, right, over increasing your prices is to sell more stuff. Now, when I say that to people, what they normally, or business owners, they normally look at a marketing program which takes time and money. I would prefer looking at things like joint venture partners, okay, which is a much better way to increase your leads than a marketing program. Okay, when you think of how your marketing campaigns are going at the moment, think about how much time and money you're spending on actually generating leads from that campaign. Okay, so I'm going to introduce you to a couple of real key strategies that will work for you, and they will work for you instantly. Okay, they'll also be they'll take less time and less money to implement. So as I said, joint ventures, which I'm going to go into a little bit of a strategy later on in this presentation. But the next one is upselling, cross-selling. It only takes a few minutes to implement and you get instant results. The other one is downselling, right, which gives buyers a lower cost option. Now, I'm going to explain these in a little bit more detail, right? But the one that I really love is bundling. It removes the price competition from people's minds straight away. So if you're struggling with increasing your prices, look at bundling a couple of your product or services together, which will remove the price objections in your prospects or your customers' clients' minds. The next one is introducing additional products and services. Now, in some cases, you might not have additional products and services to be able to offer to your clients, right? So you look outside, that's where joint ventures come in. You look at strategic partners that could add value, additional product or services to your clients that you don't actually deliver to them. So, don't think, oh, I don't have any additional product and services. You got to think outside the square. Think of, okay, what else does my client need when they're purchasing my product or services? And who can I align myself with, another business that provides those products and services? Option number 3 is lower your break-even point. Now, I've showed you a couple of strategies, increasing your prices and lowering your costs, right, to lower your break-even point. But what is break-even point? Well, the definition of a break-even point is the revenue level at which the gross profit pays the overhead costs of your business, which means that your gross profit will pay all the costs in your business, your cost of goods and really your overheads, right? So there's only really 2 numbers in your business that you really need to be concentrating on, and that's your gross profit percentage and your overheads, right, in there. So if we go back to our little bit of a graph and or a little bit of a matrix, and I've got some numbers in there that we can play with today. So a revenue at 300,000, cost of goods at 180,000, which means that cost of goods from revenue, we get our gross profit dollars at 120,000. Gross profit percentage is now 40%. In this particular case, our overheads is 60,000, which means that our net profit, our overheads from our gross profit gives us a net profit of $60,000. Okay, so if we start looking at how we look at our break-even point, the calculations is our overhead divided by our gross profit percentage. So if we take the 300,000, or really looking at our overheads, which is 60,000, we divide it by our gross profit percentage of 40%, we actually get $150,000, right? So is that our break-even point? Well, let's put it into our P&L graph and see if it populates out. So let's put our revenue in at $150,000. Let's look at, is that our break-even point? Is that what I need to be generating to pay all my bills, my overheads, and my cost of goods? So we know that our gross profit percentage is 40%. Okay, so we look at our gross profit dollars, which is 40% of $150,000, gives our gross profit at $60,000. Now, if we take 60,000 from 150, we get our cost of goods sales. So we're just re-engineering that. We're reversing the numbers around to get what we need to do. So if we take our gross profit from our revenue, we get our cost of goods at $90,000. Now, we know our overheads are $60,000. We take our overheads from our gross profit, we now get a net profit of 0, which means that our gross profit is paying for our overheads. At a 40% gross profit margin, we know that our revenue needs to be $150,000 just to break even. So hopefully you can follow those numbers with me, right, and work it out in your business. But when you hit break even, you're now making 40% on every dollar of revenue. Right? Now, that's why we call the gross profit a holy grail for business owners. Right? There's only a couple of numbers in your business that you really need to be focusing on, and the only ones that you can really control is your cost of goods, right? Is your gross profit and your overheads, okay? Because your revenue and your net profit are your the reverse effect of those. So if we come back to our graph, right, and we're looking at more break-even analysis, right, as I said before, our break-even point, right, is where your total cost crosses your total revenue. That is pretty much your break-even point. But when we reduce our costs, right, or increase our prices, as I said before, our break-even point now actually is a lot lower. Okay, so you need to be selling less units, right, to then start breaking even. So as I said, right, increasing your prices and lowering your costs are the most effective, easiest and fastest way to bring down your break-even point and to start increasing your profit. So if we look at the profit zone, what do we really need to be looking at to really look at increasing our profits? Okay, now brings us to option 4, which is leveraging the P&L. Now, right, P&L stands for profit and loss from your accountant, right? But we're only looking at very simple numbers here. We're not looking at the numbers that you would be looking on your profit and loss statement that you get from your accountant. But this simply means that you need to know which areas of the profit and loss can make the most money and in the shortest amount of time at zero cost. That's what we're looking at. So for example, should you lower your overheads or increase your revenue? Which one should you look at first? So I'm going to go through a little bit of an example for you to say, should you be looking at lowering your prices or lowering your overheads? In this case, we're going to lower your overheads by 20%. So in this case, right, we have the revenue the same, the cost of goods the same, the gross profit and the gross profit percentage, but we're going to reduce for 60,000 overheads by 20%, which gives us $48,000. And net profit now becomes $72,000. So decreasing, right, our overheads will give an increase in profit of $12,000. Now, note that's not an increase in revenue. That's an increase in profit. Okay. Now, how much increase in revenue would we need to do or you need to generate, right, in this particular business to get or to generate $12,000 in increased profit? So what revenue level do we need to be getting? So if our gross profit percentage, right, is 40%, right, it means that we're making 40 cents profit in every dollar that's sold. So for $12,000 increase in profit, our calculation needs to go 12,000 divided by 1.4, which is 40% gross profit, right, percentage, gives us $30,000, which means that we need to increase our revenue by $30,000 to get $12,000 in increased profit or added profit. So every dollar reduction in overhead costs generates 100% of that amount to your bottom line. It goes straight to your bottom line. So you reduce your overheads by any amount of money or percentage, right, and it'll hit your bottom line straight away. But every dollar of increased revenue that you generate will only deliver 40 cents. That means reducing overheads has a greater impact versus increasing your revenue. So I always look at increasing your price and cutting your costs. Okay, it will always return 100% to your bottom line. So if you're worried about where do I start in my business, what do I look at first? Look at increasing your prices and cutting your cost. It's definitely going to hit your bottom line. It'll give you some instant returns on your profit and your net profit in particular. Now, option number 5 is use profit acceleration. Now, profit acceleration is compounding, right? Now, if you've heard of compounding before, right, you probably understand what I'm saying. But banks and all the financial institutions really get behind compounding. Now, in this case, when we're looking at increasing net profit, if we impact the 3 areas that I said that can really be impacted, right? So we're looking at a revenue. If we increase our revenue, in this case, from 300,000 by 5% to 315,000. Our cost of goods will reduce by 5% from 180 to 171,000. We now get a new gross profit of $144,000. Our gross profit percentage jumps to 46%, right? And we're looking at our overheads decreasing or decreasing by 5%. Our overheads from 60,000 now comes to $57,000. Our new net profit is now $87,000. So if we looking at a 5% impact in those three areas, we now increase our net profit by 27%. Can you now see how profit acceleration is a very, very good tool to get behind, right? That's going to increase your profits, right? If you're struggling to make money out of your business right now. Now, I always talk about percentages rather than dollars because it's easier to work out. And also, when we're looking at compounding, a small little increment change in percentage can have massive amount to the dollar amount when we look at it. So your 5 options to increase your profit zones are increase your prices, sell more stuff, lower the break-even point, leverage your P&L, use profit acceleration. Okay, so those are the things that you want to be concentrating on. Now, remember our 2 top goals for what I was going to teach you today. That was to show you how you can generate the exact same amount of profit as $1 million business with just 25% of that revenue. So in this case, be $250,000 in revenue. The other one is how you can double your current profit in less than 90 days. Both of these can be achieved by looking at what I call the profit acceleration simulator, right? Because this is what I do on a day-to-day basis with my clients. So with the profit acceleration simulator, I can show you the awesome financial potential of your business, right? By understanding the power of compounding, as I said before. Now, we call it the profit acceleration. Now, you probably heard this before. If you get a penny and you double it every day for 30 days, you'll become a millionaire. Well, in reality, you'll be a multi-millionaire, which is over $5 million, right? That's the power of compounding, okay? We talk about profit acceleration when we talk about compounding. It simply means that small incremental improvements can result in massive increases in revenue and profits. That's what I want to try and teach you today. So to help you understand this fundamental concept, we've created what we call the profit acceleration simulator. So let me show you how you can make the exact same profit as $1 million business, but with just $250,000 in revenue using the profit acceleration simulator. So this is a profit acceleration simulator, right? And what we do is we put in the annual revenue, right? We also put in the gross profit margin percentage. We put in the net profit percentage as well. And we look at your currency, whether it's AUD, USD, or some other currency. And then we look at just having a percentage impact on 12 areas of your business. These are the 12 areas that I concentrate on, and they're actually part of my book, Dominate Your Market, right? What the marketing experts don't tell you. These 12 strategies I break down in my hard copy and downloadable book, Dominate Your Market. And it just goes from cutting costs to market dominating position, right up to upselling, downselling, bundling, these things that I've spoken about before into drip campaigns. But when we're looking at those 12 areas, right, how can you make the exact same profit as $1 million business with just a $250,000 in revenue? So if we start off with $1 million business, right, with a big widget maker, in this case, with a gross profit percentage of 50%, right, and a net profit of 25%, if we put those numbers into the simulator, okay, and we look at the profit from that is $200,000. Okay, so with a 20% net profit margin at $1 million, they'll be generating $200,000 in net profit, right? Now, this is before taxes. Now, we want to generate the exact same amount of net profit with just 25%, or in this case, $250,000. So let's go back to our to our simulator. We put $250,000 in, same 50% gross profit margins, 20% net profit. In this case, we have a $50,000 profit with that, but we want to be going to 200,000. So we're 150,000 short of our profit goal. So when we look at the impact, right, of those 12 areas, and we just put in an increase of 6.6% in those 12 areas, right? We now have a profit of $200,000. Now, in the last probably 15 years that I've been working with my clients, okay, a 6% increase in some of these areas is just really, really easy, right? I get more like 10%, 15%, in some cases, 30% increase. So you can now see that generating the exact same amount as $1 million business in revenue with 50% gross profit and 20% net profit, right, only requires a small 6% increase in 12 fundamental areas. Okay. Now, one of the areas that we look at, as I said before, is joint venture partners. Now, if you don't know about joint ventures, it involves two or more businesses that decide to form a partnership to share markets or endorse a specific product or service to their customer base, usually under a revenue share arrangement. Now, the key to creating successful joint ventures is to find partners who serve the exact same type of clients that need or want what you sell. Now, let me give you an example that we're all familiar with, and that's a florist. Now, one of the most financial lucrative product lines for a florist is providing flowers for weddings. Now, the average floral bill for a wedding often exceeds $3,000. But what we discovered about florists is they fall into what we refer to as an event chain. An event chain simply refers to a series of businesses that customers purchase from in a specific sequence. Now, how do I know this from a florist? Well, I did own a florist, okay? That's my lovely wife there and me in front of our florist shop, right, with a couple of examples of our florists. And I've used this exact same example that I'm going to show you right now in event chain that doubled our profits and our income in a very short amount of time. So if we talk about the wedding industry, the typical event chain for vendors when someone is getting married goes like this. It starts off with the jeweler, right? Because no wedding or any wedding proposal happens until the groom or the potential groom goes to a jeweler and buys an engagement ring. Okay. Once that happens, the bride takes over and starts organizing the wedding. So they'll go to a wedding planner, they'll go to a church and chapel, they'll go to a reception venue because they know that they need to book that probably 12 months in advance, right, just to book that in. They probably go to the wedding dress and then they come to the florist. So there's a little bit of a sequence that the groom goes through, right? They then go to the wedding cake and the printer, and they might go to the limo driver, the DJ, the suits for the groom, all those things that are associated with the wedding. But there is an event that, you know, a chain that the bride goes through in a sequence to plan their wedding. Now, what we're going to talk about is the florist. So everyone above the florist is perfectly positioned to refer businesses to the florist. The businesses below the florist is perfectly positioned to receive referrals from the florist. Okay, so I hope you understand where this particular florist fits into the wedding chain. Okay, you know, the people have already been to the wedding chapel, they've already been to the reception venue and probably the wedding dress before come to the florist, which means that they can't refer people, right? But vice versa, they haven't been to get their wedding cake or the printer, for example, so the florist can then refer to them. Now, if you think about it, right, could this florist obtain just one referral each month from just one of the businesses above them? So getting a referral once a month from at least one of the businesses above them. Right. Next, could the florist send just one referral? So give one referral each month to each business below them, right? So in this scenario, right, if the average net profit for the florist wedding flowers is $3,000, right, then just a single referral per month produces an annual profit increase of $36,000. Okay, so think about that, just one referral. Vice versa, right? If the average sale price for the wedding cake is also $3,000, which is what we found, and the florist receives a 10% referral fee by referring that person to the wedding cake maker, that single referral, right, could produce a monthly additional profit of $3,600. Okay. Right. So if you look at the printer, right, and we've looked at this as the printing is probably about $1,000 for a wedding, you know, to get their invitations done and their cards and all that. It's around about $1,000. Same thing. As a florist, we set up a 10% referral fee to a printer to send them business, and that brought us back each month an additional, right, money, which is an annual profit of $1,200. So it's 10% on the $1,000 each month over a 12-month period. So if we add all that up, right, we were probably averaging about $40,000 in additional profit, right? But with the extra 3 referrals that we were getting, right, it gave us an extra $40,000 in increased profit. So it's 102% increase in our net profit, just with conservative numbers. Imagine if you had 4 or 5, even 6 people referring people to you, right, regularly each month into your business. What would that do to your sales, revenue, and more importantly, your profit? Okay. Now, to add it on to that, I produced a little bit of a report that was titled "The 8 Things Every Bride Should Know to Avoid Their Disaster on Their Wedding Day." It was more to get people as a little bit of a lead magnet and a download to get them onto my database. But what we did in that, or what I did in that report, was that we added, right, a booklet or a coupon booklet in there with our florist JV partners that they could take and use. So it was a very online sort of campaign that people downloaded that book, the 8 things you could, problems have people or brides have to overcome disasters on their wedding day. They would download that, but at the back there was some coupons that they could go start using, right, with our JV partners, and we were getting a return back on that investment as well. So you just got to think outside the square on what you could do in your business as far as JVs and strategic partners. Now, the next one I want to talk about is upselling and cross-selling, right? Because I think that it brings in big profits. Now, upselling and cross-selling, what it means is upselling means offering a higher grade or quality or size of the item that the customer may be interested in at the point when the customer is ready to buy, which is very, very important. It needs to be done at the point of contact when they're actually buying your product. Cross-selling means offering another product or service which is complementary to the item the customer is interested in. Right now, as I said, it needs to happen at the point when the customer is ready to buy, because 34% of prospects will buy additional products or services at the time of their original purchase if they're asked to do so. But you know what? I see probably 80 to 90% of businesses do not ask for an upsell or cross-sell. Think of McDonald's, right? They're always asking for an upsell, right? A higher grade or quality of size, right? They're also looking at the cross-selling, which is the apple pie scenario. So think about that. Upsell and cross-sell. I'm going to give you an example for a dentist that I work with, which offers basic dental services like exams, teeth cleaning, but that is not where they make their money. The money is made in, or their revenue comes from cosmetic services such as root canal, crowns, fillings, and braces. Now, what you've got to consider is that, what convinces someone to leave their current dentist, right? Because if they're happy with their dentist, they're not going to leave. Now, what we found was that 85% of the population have medical insurance, but only 50% of those have dental insurance, which means that they're not covered for dental. So among these, without the dental insurance, 44% said that was the main reason they didn't visit the dentist, right? They didn't go to the dentist because they didn't have dental insurance. So can you see an opportunity here if you were a dentist? In this case, what do you think would happen if a dentist specifically targeted families without dental insurance and offered them virtually the exact same services as those with dental insurance, okay, but without paying the expensive monthly premiums, okay? So, I mean, they're looking at that target market. These are some of the campaigns that I ran with my dentist, okay, in regards to that problem that people had. The dentist, by offering a routine exam and cleaning for $25, which is normally co-paid by the insurance anyway, covers the cost for the treatment. But then they can upsell all their additional service they need, such as fillings, crowns, dentures, braces. And as I said before, that's where they make their money. Now, this dentist, in this particular case, increased their net profit by 27% just by looking at this strategy outside what they were normally doing. Now, if we talk about a restaurant, we're talking about cross-selling, right? I've owned a couple of restaurants and cafes in my time, and this is one of the biggest strategies that I use to actually increase turnover, revenue, and which then came to the profit line. Now, I instructed the staff to bring an appetizer or a wine cart to each table before the customer ordered, and they offered free individual samples to increase the sales of both offerings, from the appetizers and the entrees to the wines as well. Okay. Now, we repeated this at the end of the customer's meal by bringing them a dessert card. So before the meal, we brought them, items around entrees and appetizers and the wines. Afterwards, we brought the dessert card around, and we offered them free samples. Now, it was just to entice the customers, the patrons, to order a dessert. But the taste and reciprocity from having those free samples instantly doubled the appetizer, entree, the wine, and the dessert sales. And they were the highest marginal offerings in the business, or in the restaurant. So the restaurant dramatically increased its total order revenue by just implementing and initially putting in an order upsell strategy with the wait staff. So think about how you can leverage your staff, right, to actually have a script in place that's going to have an upsell cross-selling automatically. Now, we trained the staff to describe the more expensive entrees on the menu and give the customers their personal recommendations. Because if you ever go to a restaurant, you'll know that most customers go with staff recommendations. And we were training our staff to recommend the higher, marginable items on the menu. So this easily increased our net profit by, 15%. It probably went more than that, but I think it was around about 50% where we started. When we got better at it, it increased. So the next one I want to talk about is how to stop discounting, right, and offering additional value through bundling. It's one of my favorite strategies. Now, bundling is simply the process of grouping together certain products to create packages which are then sold to your clients. It creates an apple to oranges comparison and removes price from the equation completely. The customers today shop value, not price. You need to understand that. Unfortunately, small businesses are lousy at conveying their value proposition. Therefore, price becomes the only value proposition left to the consumers to make a decision. So with bundling, the real key to success in marketing is to offer more value than your competition. Prospects will pay twice the price if they believe they're receiving 4 times more value. Right? Now, unfortunately, businesses, in a vain attempt to increase their value, begin to offer discounts. And that, as we mentioned before, often destroys their margins. So remember, as I said before, businesses that discount their price by just 10%, now have to sell 50% more just to break even. So consider a home builder that I had on board, right? They also were a renovated company as well, but they were really specialized in building new homes. Now, they typically they have contracts with certain suppliers that offer them huge volume discounts, especially around electronics. If they buy in bundles or they buy in volume amounts, they get really, really big discounts. So the builder that I was working with agreed to buy multiple packages of a whole house entertainment and security system, which included a 50-inch high definition TV, a complete high quality surround sound system, a complete home security system that included surveillance cameras at all entry points to the home, and a complete fire protection and monitoring system. Right. So they looked at purchasing these in volume. Now, the retail price for this package was $22,800 installed, but the builder acquired them at a volume for only $6,500 because they didn't have to have installation done, right? Because it was part of the cost. Okay, so since the builder already had the home stripped to the studs, the installation for the home entertainment system package, right? They could handle the installation of that by their crew at a very, very minimal cost. Okay, so now imagine this builder competing with other builders in a moderately priced neighborhood, right? All builders in their competition offered homes in the $300,000 price range. But our bidder could offer their homes for $360,500, which included the additional $6,500 out-of-pocket expense to the builder, and their home comes standard with a $22,800 home entertainment and full security system for free. Which builder would you buy from? You know, I want you to be thinking about that. Which builder would you buy from? In fact, right, what if the builder offered that new home for $310,000, right? Do you really believe that additional $3,500 would prevent anyone from buying this home? Because you've got $22,800 in value added to the top of your home. Now, you know, it really looks, you know, it looks like a much better deal than the $300,000, right, with the home entertainment system in it. But if the additional $3,500 increase did make a difference due to the loan qualifications or standards for getting that loan, and the prospect just couldn't borrow that amount, the builder always has the option of reducing the price back down to, you know, $306,500 from the $310,000 originally. But in this case, because of the downturn in residential construction, my builder kept, elected to maintain the original price at $300,000, right? Still gave the $22,800 value in there for the home entertainment system, but kept the price the same. But what had happened was that they lowered their margins on each home sold, okay, just to be competitive out there. But what happened was that these builders, I mean, most builders that sell their homes for $300,000, their profit margin is about 30%, which means that for every $300,000 home they sold, they netted $90,000. But because our builder included the package which is with each home, their margins were reduced from 30% down to an average of 26%. But all the other builders were averaging homes at about 5 to 6 homes a year on average. But when our builder offered to include the $22,800 package at the same price, they started averaging about 10 homes sold per year. So they were building about 10 homes compared to the others out there, which were about 5 to 6. So if we break that down, the average builder that was selling their home for $300,000 with a 30% profit margin, right, getting $90,000. They were doing 5 homes a year. They were netting $450,000. But our builder, $300,000, but their profit was only 26% now. They were only netting $78,000 out of each home, but they increased the amount of homes that they were building, which brought in a net of $780,000. So that's using that bundling strategy. Our builder increased his net profit by 73%. Okay, so I mean, if you look at that, right, okay, you can see that there's a perceived value to there, right? Same price, but you're getting $22,800 in additional value to your home. These are some of the brochures and the flyers that we did for them, out there, what's included in the home entertainment system and how it's all broken down. And we did an evaluation versus the other ones out there. So what you get free in our homes compared to our competitors' homes. So it was a real campaign around adding the value out there at the same price. But as you can see, they've got increased homes that they were building each year, which then brought in the additional revenue anyway, increased profits. So if we start breaking down what we've spoken about today, our florists increased net profit by 102% just using 3 joint venture partners. All my clients, I work with them to get at least 6 to 10 joint venture partners referring to them each month. Okay, and in some cases, that is their whole marketing campaign, working with their joint ventures to get referrals into their business. The dentists increased their net profit by 27%. The restaurant increased their net profit by 15%. And, noting that this is a low marginal business model, if you ever know about restaurants and cafes out there. And our builder increased their net profit by 73%. Now, how would you like to see similar gross profit gains in your business? In fact, how would you like to double your current profit, right? And as I said, how would you like to do it in 60 to 90 days? How would you like to do it without spending a cent on marketing or advertising? So if we go back to our profit acceleration key, right, and we look at some numbers, and in most cases, right, a lot of startup businesses or businesses that have been in the infancy or really in that growing stage, they're hovering around about $100,000 to $200,000 revenue line. So let's put in $100,000, right? And we look at the gross profit margin of 50% with a 20% net profit, right? Now, if we want to be doubling the profits for this particular business, right, currently, they're only producing $20,000 in profit using that scenario. But if we go back to our 12, key fundamentals that we should be looking at, so like cutting costs, bundling, increasing our prices, upselling, cross-selling, all these strategies that we look at, and look at a 2%, 2.6% increase in those 12 areas. So we're only looking at 2%, right? What we get is we now double our annual profit. Okay, so to double the net profit of any business with a 50% gross profit margin and a 20% net profit only requires a small 2.6% increase in these 12 fundamental areas. And, in the last 15 years, I have never seen any business, right, with a 2% increase in any of these areas. It is a lot more, right? The lowest I've probably seen is about a 5 to 6%. Okay, so think how your business could increase their profits just by concentrating on these 12 fundamental areas. Now, if you only need 2.6% to double your current profit, what will happen if you get a larger percentage increase, such as these, our florist, our dentist, the restaurant, and our builder, right? These are real life numbers that I've used with my clients to get these results. Now, how would you like to find out, right, in your business, what 2.6% would do to double your current profit? What would it mean in your business? Why don't we find out? Right? I have an offer for you to meet with me for 45 minutes free of charge. And I will use the simulator and I'll find your exact percentage increase that will double your current profits right now, given your unique set of business challenges and opportunities. So together, we'll determine the individual percentage for each of these 12 areas as they apply to your specific business. Now, I will develop a customized roadmap and a report, right, that you can follow that will ensure you to generate a maximum profit all for free. So if you're interested in that, right, please book a session now, right? You can email me at paul@cecoaching.com.au, or you can just go to my Calendly link and book in a free call right now. Now, I can only take a few businesses each week. So first in best dress, right? And I only do that because I really want a focused approach. So if you're interested, get in there as soon as you can and book a call. This is going to be free. It's going to be no cost to you, right? And it's a thank you for listening to me today. So I hope you found this presentation valuable and that the information that I've provided will enable you to generate more revenues and profits in your business. Now, I want to thank you for joining me. And if you do have any questions, feel free to reach out. Send me an email, paul@paulduncan.com.au, right? And I'll be able to answer any questions you've got, right? Or book in for that free profit acceleration software where I will find you, that additional profit, right? Whether it's doubling your profit or just getting a little bit more profit out of your business, working on maybe even one or two of the 12 key areas within your business. But what you'll find is that you'll get that report and that roadmap that you can take away and you can implement them yourself, right? What I find is that a lot of business owners come back to me and say, look, I need some help with this, but the profits are there. They can then start, paying for business coaching, because if you're thinking, I would really like a business coach, but I can't afford one, what I say to you is that you can't afford not to have one. And when I take you through 45 minutes to an hour, and I will find that fee that a business coach will charge. So in essence, business coaching is free, okay? And you'll be working with somebody that's going to really, really generate your business to a whole new level. So guys, thanks for joining me. I really want to thank you for coming on board and listening to me for the last hour and a half, because a wise man once said to me is that we can generate, we can lose money and generate more, but once we've used our time, it's gone forever. So I want to thank you again for joining me, and please reach out, get on board, book a call with me, and we'll be able to do your particular challenges, frustrations, and find some profit in your business. Thanks again, and we'll talk soon.